Morning, everyone. I'm Vince Lancy. We're going to be doing a slightly different market rundown, recapping yesterday. Starting with the markets, the S&P 500 is 60.49, down 15. VIX is 1602, up 22. Gold is 28.91, down 16 on the lows. Silver 31.52, down 48. Copper 4.56, down 10 cents. Looks like they found the metals. WTI 73.69, up 88. Natural gas 368, up 4, almost 5. Bitcoin 97,800, up 380. Palladium and platinum are both down 8 and change at 969 and 978 respectively. Gold, silver is very strong now, almost 92. Soybeans 1051, up 4. Corn 488, up 1.5. Wheat 597, up 6. Okay, there's the front page. Multiple stories on multiple topics, all related to precious metals and gold specifically. What we'd like to do today is we sent out a post yesterday, late in the day, called Addendum. The catalyst is Basel III. And we want to put a little more meat on that for you because it ties in with the reason for the moves. Where were we? Quickly. This is the short open interest chart. So short open interest is climbing again, but we don't think there's going to be a lot more of that. However, you never know right now, especially with all the gold that's been delivered into New York out of London recently. All right, so gold hit a new all-time high yesterday, officially reaching our personal measured move target. Now, while a push towards 3,000 is possible, current technicals alone do not support that call. However, broader macroeconomic and market dynamic measurements strongly argue for possibly as high as 3,500, given the way things are developing. And what do I mean by the way things are developing? Well, we mean by this. Let's go through some key drivers. People are looking for a silver bullet for the gold rally. It's more like death of 1,000 very heavy, very deep cuts. The first cut, we're going to call that the tariff cut. That's the order that we're taking them. So trade tariffs and market uncertainty would be the first driver. Now, while gold has not yet been targeted by tariffs, the broader policy shift is bullish for gold as an alternative to the US dollar, which tariffs would make less, more risky, even though you still need it. So gold does not need to be directly included in a tariff list to benefit. When protectionist policies expand, demand for hard assets like gold naturally increases, if for no other reason as a hedge for your own necessity in owning dollars. The second is Citi's gold upgrade. Last week, Citibank released a report projecting to 3,400 before settling on a more conservative 3,000. Their reasons were pretty compelling. The shifting targets suggest to us a careful but bullish stance, reinforcing the idea that institutional support for higher gold prices is building. Institutional support for higher gold prices means central banks are buying it at higher levels. Those words have meanings, even though the press abuses them. This is not a trivial report. It reflects a broader recognition of gold's structural importance in the current financial landscape. Structural importance. That word will come back when we discuss China. Also, we discuss more about tariffs in section 5 of this report. Next, GLD short selling restrictions signal physical tightness. Now, the GLD ETF has restricted short selling, which is an indirect indicator of tight physical gold supply in London. Not that we need an indirect indicator, we see direct indicators of it now. When shorting GLD becomes difficult, it suggests that securing physical metal is increasingly challenging. This points, I should say, directly to tightening supply conditions in the physical gold market. Now, this may be old news with a delivery that was made yesterday, but it's a phenomenon that's not going to go away. All right, the next one is exclusively from us. Gold producers are covering shorts at record highs. Now, over the weekend, gold producers, this is something we put out for founders yesterday. We're going to be sharing this with Premium during the week. But there are two slides in here we want to share with everyone right now. And that is, over the weekend, we noticed gold producers began covering short positions at all-time highs. It's a very unusual move. This indicates miners are not confident in prices dropping, signaling a fundamental shift in supply side dynamics. Historically, producer hedging tends to increase at market tops, but covering shorts at record levels suggests ongoing tightness. The fact that bullion banks are among those covering shorts is also significant. Okay, so the charts that we're referring to. This chart on the left, the red rectangle, represents the 5 days covered by the CFTC Commitment of Traders report. It was an up week. The right-hand side is the 5 days that we use for a more granular analysis, given to us by Randall Blava, a founding member, a longtime founding member. Keep that in mind. Up week, market rally. Now, on a week like this, where the market's rallying, the bullion banks should sell, meaning they have to sell to whoever's buying. That's normal. The buyers are funds, speculative funds that buy. That's the normal behavior. Lo and behold, it was not a normal week. The blue rectangles represent cohorts. The left-hand side is producers and merchants and processors and users, and the right-hand blue rectangle is swap dealers. The left-hand side of the left-hand rectangle, longs. We don't care about them. They didn't do anything. Shorts, producers covered, follow the arrow, covered 17,900 contracts in a rallying to all-time high market. That is not bueno. That is not good. Is it the end of the world? No. Have they done it before? Yes, but not in this size and not in this type of a rally. The swap dealers, long and short, so the spec swap dealers are pretty much on the long side. They sold 7,900 contracts. The short swap dealers, as expected, got shorter 14,000 contracts. And the funds did what they do. Some of them buy, some of them sell, some of them get hurt, some of them don't. But the smartest money historically, the money that has the most to lose in markets, are producers. For them to cover is signaling more than one problem. Now, somebody's getting hurt. We don't know who. But this is the type of behavior that makes me think about producers. Although we'd love it to be a bullion bank because we've all been scarred by them, and they're the kryptonite for silver and gold rallies. Historically, when there's a problem, the bullion banks are the last. The big bullion banks are the last to get hurt. The producers, however, who tend to overhedge for cash flow purposes, they do get hurt. So let's see. But that's extremely important, and that's an important take away when you read these CFTC reports. We'll share the whole thing with everyone in a little bit tomorrow. Okay, the next driver of the rally, China's massive policy shift on gold. We reported this today. China has announced a pilot program allowing its top 10 insurance companies to own and offer gold-backed products. This is equivalent to the U.S. insurance company suddenly being allowed to buy and offer Bitcoin-based insurance products. Previously, Chinese insurers were not allowed to hold gold, meaning this move could is a nice word, will unlock substantial institutional demand. By the way, footnote, it was about 8 months ago we noticed a report coming out of the World Gold Council, which is notoriously neutral on the price of gold, extolling the virtues of asset managers buying gold. And it was written in Chinese. So We think the WGC understands what's going on. They see these policies coming down the pipe, and they laid out guidelines to make it more palatable and easier for insurance companies to wrap their heads around the opportunity coming down the pipe. And here it is coming down the pipe. Okay, gold could become a central component of Chinese life insurance and annuity products, mirroring how equity-linked insurance products function in the West. There is growing speculation that China is preparing to passively or actively back its currency with gold, making this move a major step towards legitimizing gold as a financial asset in domestic markets and probably the BRICS markets as well. We just put this out, and we actually put in this story an analysis not discussed here. This is, once again, China taking an idea that we have, a good idea, and improving it by applying it to a safer asset. This is the 1980s for China. They're coming out of the box. All right, throw some charts up there, and we'll wrap this up. Market implications. Shorting gold is becoming increasingly dangerous as more financial institutions position long in response to the developments that we just described. The rest of the week is a data-heavy week. CPI, PPI, and Powell's remarks are on the calendar. Normally, these events would trigger profit-taking dips in gold, but recent market behavior suggests that dips are being aggressively bought. So watch the behavior. Shorts are disappearing. At some point, that will be bearish, but shorts are disappearing, and there's still someone out there who's short. Bullion banks are covering. Now, they sold last week, but for the previous week before that, for the previous month before that, they were seen to be covering shorts. Producers are covering shorts. Funds are avoiding shorts. The absence of new short positions suggests a supply squeeze is underway because the demand is pretty inelastic right now. Now, speaking about London's physical gold shortage, London is running out of freely available gold. When 1 billion, analogously speaking, when 1 billion ounces are stored in London and 800 million ounces are already claimed, well, then 200 million ounces are all that's left. Bullion banks are no longer trading freely with each other in London. This is reportedly out of London on the credit side, signaling a breakdown in trust due to counterparty risk concerns. They trade paper gold with each other. It's backed by real gold, but they never really exercise it. So it's basically how they do swaps with each other. And kind of like when you had the energy counterparty risk in the 90s, kind of like when the banks stopped talking to each other in the great financial crisis, the bullion banks are, I'm not taking credit from this person. I'm not taking credit from that person. I'm not taking your paper gold. They have paper gold out there as well. The system is showing signs of a bank run and a derivative squeeze, forcing gold to flow into New York instead. Now, why is gold moving to New York? Well, we just went through a billion reasons for that. But the GLD vault restrictions indicate a fundamental supply shift. July 1st, look, there are a lot of reasons contributing to it, but the thing that makes the bullion industry move off its ass are deadlines that are not moving. The election is a deadline. When Basel III was implemented in Europe was a deadline that got kicked down the road for years. When the bullion banks, Citi and JP Morgan, were forced to disclose their bullion derivatives holdings on their balance sheet, that was a deadline. All these things were bullish for gold. Well, here's another deadline that's not being talked about enough yet. And again, a hat tip to Eric. We've discussed this concept before, but he reminded me of the deadline. July 1st is a key deadline. Basel III regulations will take full effect in the US, or so they say. These regulations change how banks treat gold as a reserve asset to put us on par with Europe, removing some of the paper leverage that has historically suppressed prices, accidentally or not. If the deadline holds, gold prices could accelerate sharply. If postponed, a pullback will occur, but the broader trend remains intact. Conclusion, for us, this is not a speculative rally, although it's got speculators in it. The combination of tariffs, institutional gold demand, tightening supply and regulatory shifts is setting the stage for a structural gold market reset. Basel III is, for all intents and purposes, the catalyst, the deadline that forces people, whoever is short, whoever is naked short, if the regulations go into effect as planned, the implications can be profound. Someone is going to get caught on the wrong side of this trade. Someone may have already been caught on the wrong side of this trade and is being walked very slowly to the gallows to not upset people. And it won't be the central banks or the institutional buyers this time. That's it. There's the markets. Look, they found the gold. Their old floor broker would say to me when I was young, when the market rallied, gold rally, and we get all excited, silver rally, all excited, and then it would just come off, and I'd say, "What happened?" He goes, "Well, they found the gold." Well, literally, that phrase is true. They found the gold. So, will this be the end? No, it's not the end. It's the end of the beginning, or the end of the intermediate part of it. Who knows? But it's not the end. Uh, at the very least, you're going to have more trading opportunities in this. And when the China news dies down about their insurance industry, don't let it die down for yourself. Okay. In 1980 or 82, the US changed regulations to liberalize ownership of stocks. Ronald Reagan did that to transfer our power to a different type of economy, a financialized economy, and that made stocks. That was the beginning of the explosion of stocks, the GOGO years, the old guys used to call it, right? Or older than me anyway. Well, the go-go years for gold are beginning in China right now. I mean, you're going to start seeing uh, products with gold in it, like an annuity, variable life insurance, things like that. These are tried and true market structure inventions by the U.S. with uh, safety and surety offered by China because they don't really want the bubbles that we kind of create. I'm Vince. Have a great day.